Welcome to Talk Tickers. Normally, we are a professional earnings call summarization podcast, bringing you up to speed on corporate financials. But today we are doing a deep dive into a really fascinating financial topic.
Yeah, we are stepping slightly outside the usual earnings reports today to look at something that is totally reshaping retail finance.
Exactly. We are stripping the varnish off a corner of the market that is, it has absolutely exploded over the last 5 years or so.
Oh, without a doubt. It is everywhere now.
Right. It is a mechanism that promises the ultimate retail investor dream, right? The ability to profit from the markets without actually doing the work yourself. We were talking about the automated replication of active trading strategies.
Better known as copy trading.
Copy trading, exactly. And, we have both researched this extensively, and the hook is just incredibly seductive. You see the ads on social media constantly.
Oh, you cannot escape them. The algorithms feed them to you all day long.
Right. They say things like, don't know how to trade? No problem. This guy made 400% last month. Just click this one button, link your account, and your portfolio will do exactly what his does.
It is marketed as a total shortcut to expertise.
A shortcut, yeah.
Yeah.
A way to bypass the whole 10,000 hours of mastery thing. But, and I know you agree with this, whenever I see something marketed as a magic shortcut in finance, my alarm bells immediately start ringing.
As they should. They absolutely should.
Because the reality is this actually passive investing, or is it just passive for the person collecting the fees off of you?
That is the exact right question to ask. And the reality is quite different from that glossy marketing brochure you see online. When you engage in copy trading, you are not just quote unquote following winners.
You're doing something much more complex.
You are. You are effectively converting your portfolio into a derivative of another human being's psychology.
Wow. A derivative of another human's psychology. That is a stark way to put it.
It is the truth, though. You are delegating your execution. You are delegating your risk management. And this is the part I think most people completely miss. You are doing all of this through a technological layer that introduces systemic risks you simply do not have when you just log in and buy an index fund or a stock directly.
I want to stick with that phrase for a second. A derivative of another human psychology. Because derivatives are leveraged bets, essentially.
Right.
So you are saying we're taking a leveraged bet on someone else's mental state, their stress levels, their discipline.
In a very real way, yes. Add to that the sheer technical risks of the platforms. I like to tell people, you are handing the keys to your car over to a complete stranger. And sometimes that stranger is driving a Formula One Ferrari, and you are sitting in a sensible family sedan, but the software is trying to make your sedan take the exact same corners at the exact same speed as the Ferrari.
And the wheels just fall off.
The accounts get completely blown up. The mechanics of that replication are where the whole thing falls apart for the average person.
We are definitely going to unpack that Ferrari versus sedan analogy in heavy detail when we get to the math of lot sizing, because I think that is where the illusion breaks for most retail traders.
The math is brutal.
So for this deep dive, let's lay out the roadmap for you, the listener. We're going to break down exactly how this engine works under the hood. The actual literal signal routing.
From click to execution.
Yes. Then we are going to navigate the regulatory battlefield. Because regulators are looking at this and asking, is this portfolio management or is this just software execution? That distinction carries massive legal and financial weight.
Huge implications for who is liable when you lose your money.
Exactly. Then we will tear into the economic incentives. Why are these so-called gurus even sharing their trades with you in the first place? And finally, the systemic risks from slippage to herding that you absolutely have to understand to survive this space.
And we cannot forget to talk about the one question.
Right, the one question.
The single query you have to ask a platform that will filter out 90% of the toxic account-destroying strategies.
Yeah. We will definitely get to that.
Yeah.
But let's start at the absolute beginning, getting our definition straight, topic overview and mechanics. When we strip away the gamified, slick app interfaces, what is actually happening on a technical level when you hit that copy button?
At its absolute core, copy trading is an automated bridging system. That is all it is. It connects two distinct, entirely separate brokerage accounts. You have the leader, the signal provider on one side, and you, the follower, on the other.
So it is a real-time data bridge.
Exactly. And the mechanism is the real-time replication of the entire trade life cycle, not just the entry. That is crucial.
Right. It is not just buying what they buy.
No, it is the whole life cycle. When a leader opens a position, when they modify a stop-loss order midway through, when they adjust a take-profit target, or when they finally close the position, the copy trade matching engine maps every single one of those specific actions to your follower account in milliseconds. Or, well, it tries to do it in milliseconds.
But it cannot be a one-to-one mirror image in terms of raw dollars, right?
Right.
Because if the leader is some institutional hotshot trading $1 million account, and I have got, say, $5,000 of my hard-earned savings in my account, I physically cannot match their trade size dollar for dollar.
Yeah.
I would be bankrupt the second they open a single position.
You would hit a margin call instantly. So execution is rarely one-to-one in absolute terms. The system utilizes what we call proportional sizing. It calculates the trade size based on your capital relative to the leader's capital.
So it is a ratio.
Exactly. It uses scaling factors or multipliers. So in a perfect frictionless world, if the leader decides to risk exactly 1% of their total equity on a gold trade, the engine looks at your account and attempts to risk exactly 1% of your equity on that same gold trade.
You said in a perfect world, which immediately tells me the math is not actually that clean in reality.
It is almost never that clean. You run into severe rounding issues, broker minimum lot sizes, and differing margin requirements. If the ratio math dictates that you should buy 0.7 shares to perfectly match the leader's risk, but your specific broker only allows the purchase of whole shares, the system has a problem.
It has to make a choice for you.
It has to decide on the fly. Does it round up to 1 share or round down to 0 and ignore the trade? Either choice breaks the mathematical probability of the leader's strategy.
That sounds like a fast track to strategy drift, which we are going to get into later. But before we get deeper into the math and the sizing, I want to clear up the vocabulary.
Good idea. It gets murky.
Because I hear the terms social trading, mirror trading, and copy trading thrown around constantly, and they're used interchangeably by marketers. Are they the same thing? Because to me, they all just sound like synonyms for letting someone else drive the bus.
They are definitely not the same thing, and understanding the distinction tells you exactly what kind of risk you're actually buying into. Let's break them down.
Let's do it.
Copy trading, which is our primary focus today, strictly refers to mirroring a human trader's live discretionary order flow. You are betting on a specific person, Steve from London or whoever.
A human being making human choices in real time.
Exactly. Now, mirror trading, historically speaking, refers to following a pre-built algorithmic strategy or a black box mathematical model. You are not following Steve, you are following strategy Alpha 7, which is just a block of code executing rules.
So mirror trading is fundamentally about the code, whereas copy trading is fundamentally about the human.
Precisely. Mirror trading is robotic. It is usually much more disciplined, emotionless, but it is rigid. It cannot adapt if the market regime suddenly shifts.
And then what about social trading?
Social trading is the umbrella term. It is the entire ecosystem, the news feeds, the leaderboards, the comment sections, the upvotes and downvotes. Copy trading is merely the execution button sitting inside that broader social environment.
It really is the Facebook gamification of finance, isn't it? Social trading is your timeline, and copy trading is you actually putting your money where the like button is.
That is a great way to put it.
So let's clearly identify the participants in this ecosystem. It is essentially a three-party system, right?
Correct. 3 distinct nodes. First, you have the signal provider, the talent, or frankly, the alleged talent. Then you have the follower, which is you providing the capital. And sitting right in the middle, controlling the toll booth, is the platform.
The intermediary.
The intermediary, they provide the matching engine, they route the execution, and they give you the risk management dashboard. And crucially, they are the ones quietly collecting the spreads, the commission markups, and the fees that keep their massive marketing budgets funded.
And as we know in finance, the intermediary always eats first. Always. But I want to understand how we actually arrived at this point, because this basic concept of following a guru that is not new. People have been subscribing to stock picking newsletters for decades.
Since the dawn of the stock market, really.
Right. But the fully automated execution part, the hands-free element, that seems like the real game changer. Walk us through the historical context of how this mechanism evolved.
It really helps to view this evolution in 3 distinct phases. Phase 1 takes us back to the early to mid-2000s. This was the absolute wild west of retail foreign exchange, or Forex. I call this the analog and manual era.
Okay, set the scene for us.
It originated in physical, clunky trade rooms and really expensive subscription newsletters. You would pay a monthly fee to a guru, you would get an email alert or text message, or if we go back just a bit further to the late 90s and early 2000s, a literal pager alert.
Oh, wow, pagers. I actually remember people having those. You would be at a restaurant and a pager goes off, buy Euro USD at 1.12, and then the mad scramble begins.
Exactly. You are rushing home or finding a computer. You have to read the message, manually log into your brokerage account, which took forever on dial-up or early broadband, and physically type in and place the order.
The latency must have been massive.
It was catastrophic. By the time you actually clicked buy, the market might have already moved 20 or 30 pips. The signal the guru sent was mathematically valid at the time they sent it, but the execution for the follower was entirely flawed because of the human reaction time.
Not to mention human emotion. I imagine a lot of people got the text, looked at a chart and thought, I don't know, this looks risky, I'm going to skip this one.
Oh, all the time. Selective execution. And that entirely breaks the statistical probability of the strategy. If a strategy relies on a 55% win rate over 1,000 trades, and you only take the trades you personally feel good about, you are not copying the strategy anymore.
You were just trading your own bias.
Exactly. You are filtering their mathematical edge through your own psychological fear. You are reintroducing the very human error you just paid that guru to help you avoid.
So that bottleneck of human reaction time and emotion leads us to phase 2. The machines take over the clicking.
Phase 2, the algorithmic mirroring era. We were talking late 2000s into the 2010s. This phase is inextricably linked to the rise of MetaTrader 4, or MT4.
Which was basically the universal standard software for retail trading back then.
It was. MT4 allowed for something called expert advisors, or EAs, which were basically just trading bots written in their proprietary coding language. Broker marketplaces began to bundle leader discovery with automated execution right inside the software. You could link your MT4 account to a master signal account, and the software handled the clicking for you instantly.
So this effectively eliminated the human reaction latency, but it was still a pretty geeky technical process, right?
Very technical.
You had to understand server connections. You usually had to rent a VPS, a virtual private server, to keep your terminal running 24/7 so you wouldn't miss a trade while your home computer was asleep. It wasn't exactly a mass market user-friendly experience.
No, it was definitely for the prosumer, the hardcore retail trader. But the infrastructure it built paved the way for phase 3, which is where we are right now, the social and crypto integration era, from roughly 2020 to the present day.
And this is where the barrier to entry completely collapsed.
Completely. We saw the rise of incredibly slick mobile apps, aggressive gamification, and the integration of decentralized finance, or DeFi. You no longer need a virtual private server. You just download an app on your phone, swipe right on a trader you like, and you are connected.
The crypto element is particularly interesting here because it introduced a totally new piece of technology to the copy trading stack, the smart contract.
It revolutionized the trust model. With crypto copy trading, you have on-chain public ledgers providing immutable trade histories.
Which solves a huge legacy problem.
Yeah.
Because in the old days, a shady, unregulated broker could just fudge the historical database of a guru to make their track record look flawless.
Right. Oh, it happened constantly. They would erase the losing trades from the database so the guru looked like a god, which attracted more follower capital. But on the blockchain, the trade is the trade. It is cryptographically secured. You can independently verify it. And this transparency fueled a massive shift toward what the industry calls people-based portfolios.
People-based portfolios. I find that concept so fascinating. You were literally allocating capital to human beings as if they were an asset class. Like, I have 20% of my net worth in real estate, 30% in bonds, and 50% at Crypto King 99.
It is a terrifying diversification strategy if you do not fundamentally understand who at Crypto King 99 actually is or how they manage risk. But yes, that is the modern reality we are dealing with. People are treating social media influencers like mutual funds.
Okay, so let's dig into the money. We are moving into the deep analysis of the mechanics and the underlying economics. The fundamental question is, why is that Crypto King 99 letting you copy him? If he is truly a market wizard, if he has the golden goose strategy, why does he need your $500? Why wouldn't he just quietly trade his own millions from a beach somewhere?
It always comes down to incentives. There are two main revenue streams for signal providers in this ecosystem. The first one, and generally the most aligned one, is the performance fee.
Which operates like a hedge fund fee.
Very similar. This fee typically ranges from 5% to 30% of the pure profits generated for your account.
Okay, that seems inherently fair on the surface. If the guru wins and makes me money, we share the spoils. If they lose my money, I lose, but they get zero fees. They only eat if I eat.
In principle, yes, that is how it should work. But, and this is a massive but, here's where we need to introduce a critical, non-negotiable term. If you are listening to this and you take absolutely nothing else away from today's deep dive, let it be this exact concept, the high water mark.
Walk us through this. Why is the high water mark the most important thing to look for?
Let's do a practical example. Imagine you invest $10,000 of your capital and bind it to a signal provider. During the first month, the trader has an amazing run. Your account grows from $10,000 to $12,000.
Great. A $2,000 profit.
Right. And let's say the performance fee is 20%. You pay them $400 out of that $2,000 profit. You are happy, they are happy. Now, your high water mark is officially set at $12,000. It is the highest peak your equity has ever reached.
I am following you so far.
Okay, month 2 begins. The market turns volatile. The trader has a terrible month and loses $2,000 of your equity. Your account drops back down to $10,000.
I am unhappy, but at least I didn't pay a fee that month because there were no profits.
Exactly. But now, month 3 arrives. The trader rallies. They make $2,000 again. Your account is back up to $12,000.
Okay, I am back to where I was at the end of month 1.
Now, without a legally binding high watermark provision in your copy trading agreement, the platform will look at month 3, see a $2,000 profit for that specific month, and charge you another 20% fee, another $400.
Wait, so I am paying them to just recover the money they themselves lost the previous month?
Exactly. You would be paying performance fees again and again on the exact same recovery profit. You are literally paying the trader a premium for digging you out of the hole they put you in. Your account value goes absolutely nowhere, but you are slowly bleeding out in fee payments.
That is essentially legalized theft. You are paying twice for the exact same ground covered.
It is the most inefficient capital allocation imaginable. A high watermark mechanism ensures that you only ever pay fees on net new profits that exceed the account's highest previous value. Period. If a platform or trader does not strictly enforce a high watermark, you should close your browser tab immediately. Do not walk, run.
That is incredible advice. Now, what about the other revenue incentive you mentioned? Because not every platform charges a performance fee. Some say zero performance fees, which always makes me suspicious.
You should be suspicious. This is the dark side of copy trading economics. Some platforms compensate their leaders based strictly on trading volume or spread rebates. The platform pays the guru a few dollars for every single lot traded by their followers, regardless of whether that trade wins or loses.
Oh, I see exactly where this is going. This heavily incentivizes churning the account.
Absolutely. Think about the psychology. If I get paid a commission every single time I click the open trade button, and it doesn't matter to my wallet if the trade is good or bad, I am going to open as many trades as humanly possible. I'm going to overtrade your follower account aggressively to generate massive commission rebates for myself.
Because my account is just a volume generating machine for them.
Yes. Your account gets slowly eaten alive by the spread costs and the transaction fees on hundreds of pointless trades, while the leader gets a very fat check directly from the broker at the end of the month. It is a massive systemic conflict of interest.
So the rule of thumb is, if the platform's fee structure relies on volume rebates, run away. If it relies on a performance fee protected by a high watermark, you can proceed with caution. But even if you have a high watermark, there are still hidden costs inherent to the actual execution, right?
We briefly touched on slippage earlier, but we need to drill down into the physical realities of latency.
Slippage is the silent killer of automated strategies. It is simply the difference between the price you expected to get filled at and the price your order actually executed at.
Why is slippage so uniquely prevalent and dangerous in copy trading specifically? Because of the physical route the data has to travel, let's trace it. The leader, sitting in Tokyo, clicks buy. That electronic signal has to travel from their computer to the platform's central server, let's say in London. The server processes that signal, calculates your proportional lot size, and sends a new execution signal to your broker server in New York. Your broker then routes that order to a liquidity provider to execute it.
That sounds incredibly fast, though. In the age of fiber optics, we are talking about fractions of a second.
We are talking milliseconds, yes. But in financial markets, especially algorithmic markets, milliseconds are eternities. In a volatile market condition, say, right after the Federal Reserve announces interest rates, prices can whip around 20 or 30 pips in a single second.
So by the time my order physically arrives at the liquidity provider,
The price has already moved against you. You are buying the absolute top of the price candle, while the leader, who had zero latency, bought the perfect breakout at the bottom.
so the leader screen shows a win, and my screen shows a loss on the exact same trade idea.
Happens every day. If you lose just 1 or 2 pips of profit on every single trade due to latency slippage, and you are copying a high-frequency strategy that relies on capturing only 5 pips per trade to be profitable.
You have instantly lost 20 to 40% of your statistical edge.
Exactly. Over time, that mathematical bleed destroys your account, even if the leader remains perfectly profitable on their own terminal.
That is just brutal. And then there are overnight fees or swap fees, depending on the market you were in.
Yes, swap fees. If you are copying a strategy in Forex or CFD markets that holds highly leveraged positions open overnight, your broker is charging you interest to maintain that leverage. In a low volatility environment where the market is just moving sideways for weeks, you are not making any capital gains, but those daily swap fees are quietly draining your equity.
So you could easily log in, see your leader showing a nice 5% annual return on their profile, but after your personal swap fees and your slippage are factored in, your actual follower count is flat or even negative.
It is extremely common. The public track record almost never matches the follower's private reality.
That leads perfectly back to your Ferrari versus sedan analogy. I want to talk about technical constraints and minimum balance requirements. Why does the math violently break down for people with small accounts? Because I think the intuitive assumption for a beginner is that proportional execution means the strategy is perfectly scalable down to any dollar amount.
It is a logical assumption, but it ignores the hard limits of broker infrastructure. Let's walk through the math step by step to show exactly why it fails. Suppose the leader you want to copy manages a solid $100,000 account.
Okay, 100 grand.
They are a prudent professional trader. They want to risk a very small percentage of their capital on a specific, perhaps speculative setup. So they open a position size of 0.01 lots.
Which in Forex terms is a micro lot.
Exactly. It is generally the absolute smallest trade size any retail broker will physically allow you to place. It is the floor.
Okay, so the leader trades 0.01 lots on a $100,000 balance. Now, you come along, you want to follow them, but you only have a $1,000 account. Your account is exactly 1% the size of the leader's account. Therefore, to be mathematically proportional and take the exact same percentage risk, the copy trading engine should execute a trade size of 0.001 lots for you.
Right, 1% of their lot size. But you just said the broker's absolute minimum floor is 0.01.
And there lies the fatal flaw.
Okay.
You mathematically cannot trade 0.0001. The broker's servers will reject it. So the copy trading software has to make an executive decision on your behalf. It can either round down to 0, meaning it ignores the trade entirely, and you miss out on a piece of the strategy's edge.
Or it rounds up.
Or it forces a round up, it hits the floor and executes a 0.01 lot trade for you because that is the minimum allowable ticket.
But wait, relative to my $1,000 account size, a 0.01 lot trade is completely disproportionate compared to the leader's risk. It is massive. It is 100 times the risk, proportionately. The leader is risking a microscopic fraction of their massive capital buffer. If the trade immediately goes against them, they barely notice it. It is a rounding error on their daily P&L.
But if it goes against me because I was forced to round up to the floor,
You might lose 5, 10, or even 15% of your entire account equity on a single seemingly harmless trade. You are no longer copying the leader's strategy. You are artificially amplifying the risk profile due to a mathematical floor.
that is genuinely terrifying because the vast majority of retail investors start with small accounts precisely to, test the waters safely. They do not realize that the smallness of the account is the very thing amplifying their risk of ruin.
Precisely. It's totally counterintuitive. In the world of copy trading, you often require significantly more capital to be safe, not less, because you need enough of a financial buffer to ensure the proportional math actually functions without hitting those broker minimums.
Okay, let's pivot from the math to the law. Because everything we were describing, handing your money over to a system that automatically executes trades based on someone else's decisions, that sounds an awful lot like traditional portfolio management. But these tech platforms consistently market themselves merely as software providers. How do financial regulators actually view this?
It is a massive regulatory battleground right now. Authorities like the FCA in the UK and ESMA across Europe are rapidly tightening the screws on this entire industry. They're increasingly taking the stance that fully automated copy trading must be legally classified as portfolio management or investment advice, not merely passive order execution.
What is the practical difference for the listener who is just trying to use the app? Why does that legal classification matter?
It all comes down to fiduciary duty and liability. If a platform is legally classified as just an execution venue, they're basically just a tool. They are a hammer. If you take that hammer and smash your own thumb, it is entirely your fault. The platform has no liability. But if they are classified as offering portfolio management, the platform is legally burdened with ensuring that the strategy you are copying is actually suitable for your specific financial situation.
Suitability.
Yeah.
And how do regulators determine if a platform has crossed that line from hammer to manager?
They apply something generally referred to as the no manual input test.
Okay, explain that.
It is very straightforward. If the copying process is completely automated, meaning the follower does not physically have to click a button to approve every single individual trade before it executes, the regulator argues that the platform software is effectively exercising discretion over the client's capital. And that discretion triggers strict regulatory suitability requirements.
The platforms suddenly have to act like a financial advisor.
Exactly. The platform is now legally obligated to check. Does this retired grandmother truly understand the immense risks of copying a trader who is short squeezing a 3 times leveraged emerging markets ETF? If she does not have the documented financial experience to understand that underlying derivative risk, the platform cannot legally allow her to click the copy button.
Which completely explains why, when you sign up for these modern apps now, you are immediately hit with those agonizingly long, multi-page questionnaires about your net worth, your trading experience, your risk tolerance. It is not just innocent data collection for their marketing department. It is heavy-duty legal liability shielding.
It is pure compliance, and because of this tightening noose in jurisdictions like the UK and the EU, it has created rampant jurisdictional arbitrage.
Meaning companies moving offshore to avoid the rules.
Exactly. You might see a huge, famous brand name platform that proudly advertises it is heavily regulated by the FCA in London. But if you read the fine print when you sign up from a different country, you might quietly get routed to a subsidiary entity registered in the Bahamas or Vanuatu or the Seychelles.
Where the rule book is significantly thinner.
Where the rules are practically non-existent, the protections are lower, and most importantly, the allowable leverage is exponentially higher. In Europe, regulators cap retail forex leverage at 30-1 to protect consumers from blowing up. In those offshore entities, you can easily access leverage of 500-1.
And as we know, leverage is the ultimate drug for undercapitalized traders.
It is. And this jurisdictional arbitrage creates yet another fatal broken mirror scenario for copy trading. Imagine your chosen leader is a professional operating out of an offshore entity utilizing high leverage, and you are sitting in France, stuck under a strict European 30-1 leverage cap.
I physically cannot follow them perfectly.
You literally cannot. Your broker margin requirements are fundamentally incompatible. The leader might enter a massive drawdown, ride it out because they have immense margin breathing room thanks to their offshore leverage, and eventually close the trade and profit. But your European account with strict margin limits would have been forcibly liquidated by your broker at the bottom of the depth.
You get wiped out, they walk away with a win.
Right. So structural compatibility between your account jurisdiction and the leader's account jurisdiction is just as critical as the trader's actual skill level. Without structural alignment, the skill is irrelevant.
We have thoroughly covered the mechanics, the hidden fees, and the legal maze. Now let's really focus on the investor context. The sheer, unadulterated risks of being a follower. We mentioned latency slippage, but we need to talk about liquidity risk. The analogy you use in your research notes, the elephant in the bathtub. I absolutely love that. Paint that picture for us.
It is the perfect visualization of the herding problem, which is a massive systemic risk in social trading. Imagine a highly popular leader on a platform. They have 20,000 active followers copying their every move. Combined, that follower base represents $50 million of automated, blindly reacting capital.
That is a hedge fund-sized block of money moving in unison.
Exactly. Now, suppose that leader identifies an opportunity in a microcap stock or a low-volume altcoin. an asset with very thin market liquidity. The leader decides to buy.
The elephant steps into the bathtub.
The elephant steps in. The leader's personal order goes through fine. Then, milliseconds later, the copy trade engine fires off 20,000 simultaneous buy orders to the market. The first few hundred followers get filled near the leader's entry price. But the sheer sudden volume of the remaining followers creates a massive artificial spike in demand.
Because there aren't enough sellers at that price to absorb $50 million of buy orders.
Right. So the algorithm violently sweeps the order book upward, searching for anyone willing to sell. The price shoots to the moon in seconds. And it is not moving because of any fundamental news about the company. It is moving purely because of the structural herding of the copy traders themselves.
So the people at the back of the line, the last few thousand followers to get filled, are buying at a hugely inflated, artificially pumped price.
They are buying the absolute top. And the danger compounds when the leader decides to exit the trade.
Oh, man. The elephant tries to get out of the tub.
Exactly in reverse. The leader clicks sell, they secure their profit.
Yeah.
Then $50 million worth of automated sell orders hit a thin market simultaneously. They instantly exhaust all the buyers, crashing the price straight through the floor. The followers at the tail end of the execution queue get filled at devastatingly low prices.
It is basically a digital bank run, triggered entirely by the mechanism itself, executing in milliseconds.
Yes, it is a structural liquidity trap.
This beautifully transitions us into the psychological side, the behavioral risks. I want to spend some real time on survivorship bias, because this is the cognitive illusion that tricks almost everyone who opens a copy trading app for the first time.
It is incredibly rampant, and it is arguably the most dangerous part of the marketing. Think about what happens when you log into one of these platforms. You immediately see a massive flashing leaderboard of the top traders. What exactly are you looking at?
You are looking at the absolute winners, the guys with charts pointing straight up.
Right, but you are only looking at the survivors. You are seeing the small handful of people who took massive, reckless risks over the last 3 months and simply happened to get lucky on a coin flip.
The platform is actively hiding the failures.
Completely omitting them. You are not seeing the literal thousands of traders who used that exact same reckless strategy, blew out their entire accounts last Tuesday, and quietly deleted their profiles in shame.
So the statistical sample size you were using to make your investment decision is totally skewed.
It is a totally distorted reality. Think of it mathematically. If I have a strategy that risks 50% of my entire account on a single highly leveraged trade, I have a 50-50 chance of looking like an absolute market genius or a complete catastrophic failure in the short term.
Right. You either double your money or go to zero.
The platforms bury the accounts that go to zero. The geniuses who won the 50-50 bet get elevated to the top of the leaderboards, plastered with gold badges. If you decide to follow them based on that skewed track record, you are essentially just waiting for their next inevitable coin flip to come up tails.
It makes the act of winning look so much more common and achievable than it actually is. It preys on hope. And then, assuming you actually find someone who isn't just lucky, you have to worry about style drift.
Style drift is purely psychological, and it happens to the best of them. Let's say a trader builds a slow, solid, multi-year reputation by trading safe, low volatility blue chip stocks. Very conservative risk parameters. You analyze their data, you like what you see, and you allocate capital to copy them.
Sounds like a prudent decision.
It is, until the trader experiences a personal life event or just hits a bad losing streak. They get emotional. They experience ego damage. They suddenly want to make their losses back quickly. So without warning anyone, they abandon their conservative stock strategy. They suddenly start day trading highly volatile crypto pairs using maximum leverage.
The classic revenge trading spiral.
Yes. But you, the follower, are fast asleep in a different time zone. You went to bed believing you were passively invested in a conservative blue chip strategy. You wake up the next morning to discover that your leader bet the farm on a dog-themed meme coin at 3 a.m. and your account is down 40%.
Because the stylistic parameters of the trader drifted wildly, but my automated software allocation had no way to adapt or block it.
Exactly. You bought a specific strategy, but the human being executed a totally different one.
Okay, so knowing all of this, the slippage, the fees, the hidden leverage, the style drift, how do we actually filter for survival? If a listener is determined to try this and they are looking at a leader's profile, what are the actual due diligence metrics they need to ruthlessly analyze?
The first, unbreakable rule of due diligence in this space. ROI is vanity. Maximum drawdown is sanity.
ROI is vanity. Maximum drawdown is sanity.
I love that. Break that down for us.
A 500% return on investment looks incredibly seductive on a profile. But if you dig into the historical statistics tab and you see that in order to achieve that 500% gain, the trader had to endure a 90% maximum drawdown, meaning at one specific point in time, their open trades were down 90% of the total account value. That trader is fundamentally uninvestable.
Uninvestable because the risk of ruin is too high.
Exactly. Because if you, as a follower, had unfortunately linked your account right at the peak, right before that specific 90% drop occurred, your account would have been almost entirely wiped out.
Or worse, human nature takes over. I would watch my account drop 50, 60, 70%. I would panic, and I would manually click the disconnect button right at the absolute bottom, permanently locking in a massive capital loss right before the trader eventually recovers. Which happens constantly. You do not want a volatile equity curve. You want the grinder, not the gambler. You want someone who makes consistent, boring, small percentage gains with very shallow drawdowns.
What about the trader's own money? Proprietary capital.
Skin in the game is essential. Does the leader actually trade their own significant capital alongside yours? If a guru is managing $1 million of aggregate follower capital, but their personal master account only has $100 in it.
They are incentivized to gamble.
They are incentivized to take completely insane asymmetrical risks. If they hit a home run, they collect massive 20% performance fees on that $1 million follower pool. They get rich. If the trade fails and the accounts blow up, the followers lose $1 million, but the guru only loses their personal $100 deposit.
Heads, they win a fortune. Tails, you lose your life savings. That is a terrible alignment of interests.
You absolutely must look for leaders who have a highly meaningful amount of personal capital at risk in the specific account you are copying.
What about risk scoring? Every platform seems to have their own proprietary color-coded risk meter from 1 to 10.
Ignore the platform's proprietary risk scores. They are marketing tools designed to make you feel safe. You need to look for standard, rigorous financial metrics. Specifically, look for the Sortino ratio. Everyone always talks about the Sharpe A ratio, but for active retail trading, the Sortino ratio is significantly more revealing.
Why is Sortino better than Sharpe in this specific context?
The Sharpe ratio measures returns against all volatility. It penalizes a trader for any wild swing in their account. But upside volatility, when an asset's price suddenly shoots up in your favor and makes you a ton of money fast, that is good volatility. We do not want to penalize that.
Right. I am perfectly happy if my account spikes upward unexpectedly.
Exactly. The Sortino ratio isolates and only penalizes downside volatility. It effectively asks the data, for every unit of bad, negative risk this trader took, how much excess return did they actually generate? It is a brilliant metric because it separates the widely profitable but incredibly scary gamblers from the wildly profitable but highly calculated professionals.
I really like that distinction. Now, we touched on it briefly during the history phase, but we have to talk about the specific crypto integrations here. You mentioned the blockchain provides perfect transparency, but in your research notes, you highlighted a concept called MEV and the dangers of the mempool.
Yes. MEV, maximal extractable value. This is where the perfect transparency of the blockchain becomes a deadly weapon against you. In crypto networks, before a transaction is officially confirmed into a block, it sits in a public waiting area called the mempool.
And anyone can see what is in the mempool.
Anyone. And the space is filled with incredibly sophisticated, automated, algorithmic bots that do nothing but watch this mempool 24/7.
It has been called the dark forest of crypto.
It is exactly like a dark forest. If one of these predator bots is scanning the mempool and it suddenly sees a famous leader wallet submit a large buy order, the bot knows, because it can read the smart contracts, that in a fraction of a second, 5,000 follower wallets are going to automatically execute the exact same buy order.
The bot sees the $50 million elephant about to jump into the bathtub.
Precisely. The bot sees a guaranteed tsunami of demand coming, so what does the bot do? It instantly submits its own buy order, but it attaches a massive transaction bribe to the network miners, essentially paying them to process its order first ahead of the copy traders.
It cuts the line.
It front runs the trade. The bot buys the token cheap. A millisecond later, the massive wave of copy trade orders hits the market, violently driving the price up. The moment the price spikes, the bot instantly sells its tokens directly to the copy traders at a profit.
That is just incredible. They're literally extracting the value out of the slippage that they themselves are helping to exacerbate. They are picking the pockets of the followers.
It is legal algorithmic front running. So transparency truly is a double-edged sword. It proves the guru's historical trade is real, but it simultaneously broadcasts your live execution intentions to apex predators. In traditional fiat markets, you worry about thin liquidity. In crypto copy trading, you have to worry about predatory AI actively stepping in front of you.
Okay, this all sounds incredibly overwhelming. The math is against you, the latency is against you, the bots are front-running you. Is there any structural way to actually protect ourselves? We've covered the tech, the fees, the legalities, the risks. Now we arrive at the segment we promised at the beginning, the one question. If our listener is determined to sign up for a copy trading platform tomorrow, what is the single most important question they need to demand an answer to?
The single most vital question is a two-part requirement. You must ask, does your copy trading agreement strictly enforce a high watermark for all performance fees? And crucially, does your platform software allow me to set a hard global stop loss that severs my connection to the leader automatically if my total account equity drops by a specific predefined percentage?
That is quite a mouthful, but we have established why the high water mark is essential. It protects your upside efficiency so you never pay the guru twice for the exact same game. But talk to me about the second half, the global stop loss. Why is that specific feature the deal breaker?
Because a global equity-based stop loss is your ultimate emergency brake. It is the only technological mechanism that can absolutely protect your core capital from a signal provider's sudden psychological collapse.
It basically decouples your financial survival from their failure.
Yes, exactly. We have seen it happen 1,000 times. A highly rated leader enters a bad trade, the market goes against them. Instead of taking a small disciplined loss, their ego takes over. They refuse to close the trade. They just hold on to the losing position, playing for the market to turn around.
The classic ostrich strategy, just burying your head in the sand.
The ostrich strategy. And if you are actively copying them and you do not have a global stop loss engaged, you are forced to be an ostrich right alongside them as your account drains to zero. But if you have a global stop loss set at, say, 20%.
The moment my total account drops by 20%, the platform server just automatically cuts the cord.
It cuts the cord. It instantly closes all your open positions at market price, unlinks you from the leader, and protects your remaining 80%. It mathematically says, I do not care if the guru thinks this asset is going to bounce back tomorrow. I am out right now. It totally removes human emotion, both yours and the leader's, from the exit strategy.
Decoupling survival from delusion. That is brilliant.
It is the only way to survive long term.
Before we wrap up with our final checklist, I want to briefly touch on the future of this space. Phase 4, if you will, because in all our research, we keep seeing signs of AI fully entering the copy trading ecosystem. And I don't just mean algorithmic trading bots, but AI systems that actually select which human traders you should copy.
Yes, this is the modern evolution of the traditional fund of funds model. Instead of you spending hours scrolling through leaderboards trying to analyze Sharpe and Sortino ratios to pick a human trader named Steve, you just interface with an AI.
You give it a prompt.
You literally prompt it. You say, I want a portfolio with a maximum historical drawdown under 15%. I want heavy exposure to precious metals and European tech stocks. And I want an aggregate Sortino ratio above 2. The AI instantly analyzes thousands of human traders and builds a dynamic weighted portfolio of specific leaders for you to copy simultaneously.
So it creates a custom automated basket of humans.
A diversified basket of human psychology. And the fascinating part is the dynamic management. If the AI detects that Steve is suddenly exhibiting style drift, if he starts revenge trading or increasing his leverage outside the stated parameters, the AI instantly severs your connection to Steve and seamlessly swaps your allocation over to Sarah, who is performing within parameters. It fully automates the due diligence and risk management layer.
That honestly sounds incredibly promising for the retail investor, but my cynical side is immediately screaming that this is just going to introduce an entirely new layer of management fees.
Oh, there is always another layer of fees. You will pay the platform, you will pay the leaders their performance cut, and you will pay a premium subscription for the AI management layer. And ultimately, you still have to blindly trust that the AI's selection criteria are actually robust. But it definitely moves retail copy trading much closer to the multi-manager pod structure that massive institutional hedge funds utilize.
Okay, so to bring it all together, let's summarize with a rapid-fire checklist for the listener who has heard all these warnings but still wants to dip their toes into the copy trading waters. Give me the top 5 non-negotiable rules.
Number 1, demo first. Never use real money right out of the gate. Run a paper trading account for at least a full month. Physically feel the latency slippage. Verify if the mirrored results in your demo account actually match the glossy claimed results on the leader's public profile.
Perfect. Test the plumbing before you turn on the water. Number 2.
Number 2, verify the broker's jurisdiction. Are they regulated by a Tier 1 oversight body like the FCA in the UK or ASIC in Australia? If you are routed to an island nation you cannot find on a map, avoid it if you value consumer protection and sane leverage limits.
Stick to the strict jurisdictions. Number 3.
Number 3, check the liquidity of the underlying assets. Stick to massive, highly liquid markets. Major currency pairs like Euro USD, mega cap equities like Apple, or highly liquid commodities. Stay far away from leaders trading obscure penny stocks or ultra-low market cap altcoins, where you can easily get trapped as the elephant trying to exit the bathtub.
Avoid the liquidity traps. Number 4.
Number 4, diversify your leaders. Never bet the farm on one single guru, no matter how good their track record looks. Pick 3 or 4 traders with entirely different uncorrelated styles. Maybe one trend follower, one mean reversion trader, one macro specialist to smooth out your overall equity curve.
Build a pod. And the final rule.
Number 5, calculate your true break-even hurdle. If your performance fees, platform subscriptions, swap rates, and average slippage cost you, say, 2% of your account value every single month.
Which is incredibly easy to hit.
Very easy. If your friction costs are 2% a month, your chosen trader needs to generate a 24% annual return just for your account to break even and stand still.
That is deeply sobering. The actual hurdle rate for profitability is astronomically higher than people realize.
The house always takes its cut first. You are not just trying to beat the market, you have to beat the market and the house simultaneously.
Final thought from you before we close out this deep dive.
The core realization I want people to walk away with is that copy trading is merely automation. It is not passive income. You can outsource the physical execution of the order, but you can never, ever outsource the fiduciary responsibility over your own money. Technology is amazing. It allows you to perfectly mirror a digital trade, but software cannot mirror the human conviction, the emotional fortitude, or the underlying bankroll required to weather the inevitable volatility inherent in that trade. When the market violently dips, the signal provider you are copying might be totally calm because they are trading a fraction of their net worth and they have a 10-year time horizon.
But the follower might panic.
The follower might be sweating bullets and panic selling because they over-leveraged and they need that specific capital to pay rent next month. The actual execution of the trade is completely identical on both servers, but the human experience, and therefore the final financial outcome, will be radically different.
The trade is the same, but the human experience is unique. That is a truly powerful place to leave the main discussion. But it does make me wonder about something we didn't explicitly cover in the research, which I want to leave our listeners to mull over.
Oh, what is that?
We talked about AI pod managers automatically selecting human traders. But what happens to global market stability when these massive AI-driven copy trading networks all analyze the exact same data, decide to copy the exact same AI-generated mega strategy, and then a black swan event hits?
A synchronized exit.
Exactly. Millions of automated accounts attempting to dump the exact same asset at the exact same millisecond. No human emotion, just ruthless, simultaneous algorithmic liquidation. The liquidity traps we see today would look like child's play compared to a decentralized AI-driven flash crash.
That is a terrifying and highly probable future scenario.
Just a quick disclaimer before we officially sign off. This content is for informational and educational purposes only and does not constitute financial or investment advice. The past performance of any signal provider or trading algorithm is not indicative of future results. All trading involves substantial risk of loss.
Stay safe out there. Do your own due diligence.
Thank you for listening to Talk Tickers. Keep asking the hard questions and we will keep finding the answers. This has been The Deep Dive.